In this episode, Jahed and I talked with David Casey, the founder and CEO of Resource Network. Trained in political economy, David spent nearly a decade thinking about how to build local, mutually supported communities in the real world. He is a co-founder of Numundo, a network of ecovillages, intentional communities, permaculture farms, and retreat centers. That experience informs his current work on Resource Network, a marketplace and ecosystem that is using blockchain technologies to bring mutual credit on-chain. We talk about the history of complementary currencies, how they worked before blockchain, and why the composability of Web3 solves some challenges that historically limited the ability of mutual credit to scale. In doing so, we dive deep into Resource Network as a case study in decentralized finance. We hope you enjoy the episode. So, David, thanks so much for joining us today.
Thank you. Yeah, it's a pleasure to be here.
So most people today know you for your work on Resource Network, a new mutual credit protocol, but you've been thinking for a while about building inclusive economies and have kind of a really interesting background. I'm wondering if you could walk our audience through your origin story.
Sure. Yeah. So I'll go back a few years to right after I graduated from university was 2008, and the job markets were not what they are today going into that financial crash. And I decided I was deep in the study of international political economy, international trade, industrialization, and essentially looking at how countries go from being an agrarian society to an industrial society. And during the end of my years at university, I started to question the wisdom of the current path of industrialization and if it's actually one that's beneficial to society as a whole. And that led me to go as far away from the industrial world as I could possibly, and led me to a small Mayan indigenous village in the Guatemalan highlands, where I spent a couple years after university learning about, let's call it pre-industrial economic systems, agrarian systems, indigenous community economies. And really, I wanted to study and understand what could be the things that we have to learn from the past and from living examples of previous economies that were more in balance with the natural world and possibly with the needs of human beings outside of material needs. So I spent some time there in Guatemala and ended up traveling across Latin America, visiting various indigenous communities and kind of new experiments in community living off-grid. And that led me to start my first startup, which was called Numundo, which is still active today. And Numundo is a network of what we call impact centers, or spaces for the experimentation in what future kind of community economies and living systems could look like on a micro scale outside of cities, such as retreat centers, eco-villages, indigenous communities, et cetera. And that platform grew to 800 locations around the world across 80 countries. And I was looking for a way to do merchant payouts, simply paying the hosts of these spaces in the network when travelers stayed there. So I tried every fintech and banking solution available at the time. This was 2014. Eventually stumbled across the Bitcoin network, which I found to be a nearly perfect remittance network, something like email for money, frictionless, instant money transmission around the world. And so I started to use that and quickly became obsessed with the technology itself, with blockchain technology and its potential. About a year and a half later, we started doing an experiment on the Bitcoin blockchain, which was the only usable one at the time, to facilitate the exchange of resources directly between these communities, farms, eco-villages, et cetera, without using money as we know it. So we built a system of internal trade credits, which enabled a small number of retreat centers and eco-villages in Costa Rica to directly exchange value with each other. It didn't go very far, but it really opened my mind to the possibility of using decentralized public blockchains and ledgers to facilitate direct trade and what kind of blockchain-based economies could be built in the future. So that was a little bit of my origin story. During this time, I came across a number of ecological economists, Herman Daly, E.F. Schumacher, Charles Eisenstein, Dick Norgard, and these economists really opened my mind to the fact that economics, as I knew it, was more of a social science or an art than it was a hard science, and that economics can be designed differently. It's essentially a social code for the exchange of human value and human organization, and that the way that we have designed it currently doesn't have to be the way that it works in the future, and that blockchain networks are a really interesting tool for redesigning economic activity in a more decentralized and community-driven way. After that, I did some advising on a few different blockchain projects and still do. And when the pandemic hit, the travel side of the Numundo business was put on temporary hiatus. And I became more and more interested in taking this experiment that we'd run a few years earlier and making it more of a universal financial protocol where any kind of community or group of merchants or businesses could create their own internal trade network or trade economy. And that was the origin of the resource protocol.
Cool. Awesome. One of the things I love about your background, right, is often we think about entrepreneurship as binary, like something was, a massive success or it was a failure. And so often we forget that a lot of what makes entrepreneurs so backable over time is that kind of experience compounds on itself. And all of this experience that you had in kind of this offline experiment in building in Costa Rica and then building Numundo is now fueling as blockchain and these Lego blocks of composability that have allowed for bringing mutual credit systems online has really fueled your ability to build this online platform today. So we're going to talk a lot about mutual credit on this call. And so I think it makes sense to kind of define what complementary currencies are. And so there's really three types of complementary currencies. And these are currencies that operate alongside official currencies. So the first one is we can think of kind of token currencies, which, has a meaning in, the Web3 and blockchain and crypto world now. But traditionally, we could think of token currencies like air miles or loyalty points. You also have the second one is script money, where you have these localized mediums of exchange that can be redeemed for a set of goods, not just a particular good, like with a token currency, for instance, air miles. And then you have mutual credit, where essentially a service provider is paid in the form of credits, which are then kind of deducted when the service provider pays for another. Can you kind of walk us through what, in your mind, you talk a little bit about the experience that you had in building Numundo in Costa Rica before that, and you also talk about some of the economists or kind of the origins and theories from political economy that have shaped your thinking. But what do you really see as the need? What is the need for mutualism? What is it really attempting to solve?
So yeah, mutual credit is a very interesting monetary system that has existed in various forms for the way depending on how you look at it, decades, centuries, or even millennia. And you could call the first forms of money a form of mutual credit. And essentially, the power of mutual credit is that it decentralizes the issuance of credit itself. And if you look at the way that the political and economic systems of the world are structured, the issuance of credit is a very centralized system. And that leads to specific outcomes that may or may not be in the highest interests of society in terms of the outcomes for public health, for the outcomes of the health of natural ecosystems, which obviously affect economic and other outcomes for humans. And we believe at Resource that the decentralization of the issuance of credit through mutual credit systems can possibly create other outcomes that will be more beneficial for society. And one of the kind of micro problems that mutual credit solves is liquidity. It's a form of unlocking liquidity in spaces where there's a need for liquidity, and that need will create more economic activity. So I can give you a brief example here. Let's say we are a resource-rich but cash-poor group of three here, you, myself, and Jahed. And the three of us have goods that the others want. I have something that you want, you have something that Jahed wants, and Jahed has something that I want. However, none of us have cash money in the bank, and none of us have access to traditional credit facilities because for one reason or another, we are in a country where the banking systems don't serve us as small businesses or freelancers or micro entrepreneurs. So with a mutual credit system, we can unlock this liquidity. I can consume your goods, you can consume Jahed's goods, Jahed consume my goods. In a traditional economy with fiat, no transactions take place, and therefore no economic activity takes place. And so what a mutual credit system is doing is creating more value flow, more exchange, and therefore more economic growth.
Cool. And I want to tie this back to an early episode that we did with Dr. Hamid Rashid, who is the head of macro at the United Nations. And we were looking at this from a macro perspective. And I think, it might provide a good metaphor for what's happening in a micro perspective when you have an economy that's being created through a mutual credit system. So effectively, we were talking about kind of the role that the global reserve currency plays in creating liquidity shortages. And so in times of boom, money moves from the center of kind of the system, which in our time is the US dollar, right, to the periphery of the system. And essentially you have money flowing out of the US into emerging markets because there's a higher yield on that money. So money's essentially looking for yield. And then in times of bust, which we may be entering now, or times of recession, money pulls back into the center as we move into a risk-off environment where you have more and more money flowing into the US market and primarily into US Treasury bills, which are today kind of the deepest, most liquid market. And this creates huge distortions in the market because emerging market governments are grappling with higher borrowing costs because they don't have this kind of benefit of their own reserve currency. And so what you've highlighted is there's this outcome as well for individuals and businesses. And we actually saw that post 2008, right? A lot of money was the banks were effectively rescued, and they were rescued with the hope that, or specifically, they were rescued by the Federal Reserve purchasing a bunch of MBS assets off of them, right? And the goal there was if they freed up their balance sheet, more money would go to small businesses, and there'd be more kind of lending to stimulate the economy. That didn't happen. And so what a mutual credit system is trying to solve is really, it's trying to solve for that need where small businesses or individuals, but it seems like within Resource Network, and we'll talk a lot more about it, it's really small businesses can get access to credit, even though they might not be part of the traditional banking system, or even if they are part of the traditional banking system, may not want to go through all of the pain of going through kind of a small business administration application, which is the US government entity for loans in the US. Do you think that's an accurate kind of metaphor between what's happening in kind of the macro environment and what similarly happens and kind of the need that's served, or the original kind of goal of setting up these mutual credit systems?
Absolutely. Yes. So in these circumstances, we can create liquidity in emerging markets and as well in the US, where these kind of traditional systems don't reach, especially in times of recession and pullback, which I believe as well we're entering. Mutual credit systems have historically thrived during periods of recession and depression. And there is another couple value adds to small businesses, as well as economies in emerging markets, which is that mutual credit systems do not necessarily have interest attached to them, whereas the systems that you've described do. And therefore, you can see extractive principles take place in some cases where high interest rates are flowing back to the industrialized world, and that creates further inequalities. So mutual credit systems can give very favorable interest rates to the so-called edges of the economy. Yeah.
Cool. And what's so interesting about your background is you tried to do a lot of this, right, in an offline environment. And there's a bunch of challenges of setting up a mutual credit system in an offline environment. And that may be why this has not become a dominant model in the world, although there are plenty of examples of mutual credit systems being set up. As you mentioned, if you look in kind of the literature, it goes back centuries or even potentially millennia, depending on how you kind of measure these systems. But what are some of the problems or challenges of doing this in an offline world when you're not using blockchain, when you're not building a digital platform? Why do you think these systems have not become more dominant?
Yeah, so mutual credit systems are inherently based on trust, and it's multilateral trust between a group of actors. And at some point, there is a centralized platform operator or mutual credit network operator. In the most successful cases, the Veer Bank in Switzerland, Sardex in Italy, BizX and ITEX Barter here in the US. And those have had varying degrees of success. What is difficult in a mutual credit system is the ability to scale trust. And we believe that blockchain technology has that unique attribute that did not exist before. And possibly that's what constrained mutual credit networks to more local environments where you know the people that you're exchanging value with and giving credit to. And so with blockchain networks, our thesis is that we can scale trust in a way that wasn't before possible. Even in these centralized mutual credit systems, there is a degree of trust on the centralized platform operator. The Veer Bank in Switzerland, for example, that's the biggest one, very reputable Swiss bank, more than 80 years in operation. It's still a centralized organization. And so with a blockchain network, we disintermediate that as well. And the participants can actually trust the system itself without needing to rely on a centralized actor, which is, I think, a big part of the value proposition of blockchain networks in general.
Yeah, and there's also there's the trust issue. There's also maybe another example of like one of these systems offline would be helpful. There's an example of a mutual credit system in Japan where elderly people, when you'll have kind of an elderly community, and one member of the elderly community gets sick, another member of the elderly community goes and takes care of them, and then essentially accrues kind of a credit for. Whenever that person becomes sick, someone will go take care of them, right? And so you've got a local system, you have enough liquidity, right? Essentially illness in terms of the demand or illness, someone who's ill and someone who's kind of serving that ill person or helping out that ill person, and got a local economy, right? And there's trust because you have a community element to it. There's reputation. If I go and take care of you when you're sick and you don't take care of me, all of our friends are going to know it, and you're going to have kind of a big issue. There's not a matching problem because it's not like I'm selling, plumbing services and you're selling taking care of me when I'm sick. There's actually kind of a good matching issue. And then there's not tremendous search costs associated with this, right? But we're in a community together. And so traditionally, these offline mutual credit systems, it's not just been a trust issue, although blockchain kind of facilitates that. There's actually some core elements around scaling that make this kind of difficult in terms of these matching issues, the issues around search and the issues around exit. If someone decides to kind of leave the system with, a balance of where they've essentially consumed services from another member of the mutual system, but haven't paid back those services through their own work or through their own labor, either themselves or through their firm. And so one of the things that you write about a lot in this white paper for Resource is blockchain. It's not just that you could build this system by yourself overnight, right? Effectively, you came into this environment 13 years ago, right out of school. You read about kind of this philosophy. And then while this decade has happened, there's been a bunch of Lego blocks that have been created, right, over the course of the last 10 years that allow for you to actually build a mutual credit system and platform and marketplace on top of those Lego blocks. You talk about algorithmic stablecoins, you talk about automated market making, decentralized insurance, and kind of digitally transferable legal debt contracts. Can you talk a little bit about the key kind of Lego blocks that you didn't have to build that were critical to be able to build this system and this platform that you're creating in a way that's actually economically viable?
Yes. So another kind of huge problem that blockchain solves for traditional mutual credit is the incentive model. So whereas before, platform operators are often doing this out of the good of their hearts or support and solidarity for the community that they live in, running a mutual credit system is somewhat akin to running a bank or a monetary system, and it's hard work and requires a lot of skills. So having an incentive mechanism, or in other words, a tokenized network incorporating mechanism design, solves this problem by attracting talent to helping run and operate a mutual credit network that was not before possible. In other words, mutual credit has a new business model with crypto. Beyond that, the advent of decentralized finance, which I had been following closely right up before the pandemic in 2019, and I started to realize that a lot of the things that I wanted to do on blockchain networks were finally becoming possible after many years. So composable financial primitives are a revolution in finance in general. And you can do things that integrate mutual credit networks into the broader decentralized finance ecosystem. So yes, and there's also a lot of really interesting experiments with algorithmic stablecoins such as DAI and UST that we have been studying closely and building similar models around, such as partial or fractional collateral underneath the mutual credit system, where before someone could just leave a network and default and there's not much penalty. Now we have kind of multiple layers of default risk insurance, or ways that the protocol can respond to a default. And one of them is having this skilled class of people staking and underwriting credit lines that are also themselves exposed in the case of a default, and therefore incentivized to prevent defaults, curate the merchants that get a credit line, et cetera. On top of the underwriters, we have a protocol role called ambassador, and ambassadors will be staking both their reputation as well as actual tokens to vouch for the businesses and merchants that they bring into the network. So there's a couple layers of kind of risk prevention. On top of that, we've integrated with traditional legal system in a way that a merchant or a business that defaults on their mutual credit line is subject to the traditional debt collection system. And so we've managed to link mutual credit and decentralized finance into the US legal system in a way that it will be very much not in the interest of a merchant to default. Mutual credit is interesting because defaults work in a very different way than traditional finance. Since the merchant is paying back their credit line in the form of goods and services, it's not as easy to default as if you just don't have money in the bank, which is kind of part of the value proposition of mutual credit in general.
Cool. So I think it's really hard to unpack everything that you just said, which is super smart. And when I read the white paper, I was kind of blown away on a lot of this, because I read it once and I was like, oh, this is kind of weird. He's just using the legal system to essentially enforce this, but it's much more nuanced than that, and really kind of deals with certain issues around default and risk and underwriting in really clever ways. But I think to get into that, we need to kind of break it down a little bit and just talk through the economics of the transaction, right? So if I offer a fitness class and you offer, I don't know, plumbing services, right? How does the transaction actually work, right? If we're kind of doing this transaction on the system today, what's actually occurring?
Yeah,
because I'm not paying in fiat currency, right?
Correct. Yeah, so a mutual credit network isn't one-for-one barter. It's something more like multilateral barter. So each participant in the network is offering credit lines to each other mutually. This is something that we have called endogenous money, or money that is generated from inside the system by the merchants and businesses that transact. So first, the merchant gets onboarded. Let's say I'm a merchant, I sell chocolate, and I apply for a credit line. The underwriters like me, so they stake Source, which is a different token. Source is the protocol governance token, as well as the transaction fee payment token of the network. So an underwriter stakes fractional collateral, possibly with leverage given to that underwriter from delegates that delegate stake. So now I have stake under my credit line, and I have a credit line of, let's say, 5,000 resource dollars. This gives me the opportunity to spend that credit line all the way down to my credit limit, just like a credit card works. And once I hit that minus 5,000 credit limit, I can't go any lower. And I have to start offering products and services to the network to be able to keep spending. So until I get there, I can spend with anyone in the network. And keep in mind, this is a closed membership network. This isn't an open, permissionless network. Every merchant inside the network has been underwritten and qualified. So once I get to minus 5,000, I need to start selling chocolate to anyone who comes and buys from me. And in some cases, either the underwriter or members of our sales team, members team, will help drive sales, will help send merchants and customers to the chocolate seller. Those sales team, members team, will also help source products and services that the merchants want. So if there's a product or service that isn't yet in the network, we'll go and find it. And we found that supply chains are really interesting for that kind of creation of trade and exchange. But yeah, going back to your question, so the transaction, someone comes and buys chocolate from me. And that transaction is in resource dollars, this endogenous stable credit, which is only usable inside of the network. You can't transfer it off the network. It's only transferable between merchants. So I accept, let's say, 500 resource dollars for the chocolate, and there's a transaction fee for that. The transaction fee is paid in a different currency, in source, the payment token. And this is just like gas fees paid in ETH, right? So any transaction on the Ethereum network, you need ETH to make that transaction happen. And in our case, source is the transaction currency. And source is therefore the kind of unit of value that helps connect the mutual credit network to value outside in the greater DeFi ecosystem. Since source itself is a liquid token that's tradable on DEXs, and source is the collateral token as well.
Got it. And so I think...
go ahead, John. No, go ahead.
I was going to say, this might be an interesting point to sort of jump in, because I think like you've described almost like a prefigurative world inside of the one that we live in, right? Kind of saying, hey, how do we actually build the systems that help us relate in new ways inside of this way that exists already, right? So I guess one question I want to ask is relative to this question of scale, right? Like, do y'all actually want to kind of scale? Like, how much does scale play into this, right? Like, because, I know folks look at this from the outside, mutual credit systems, like USV has been writing about these for like 10 years or something, right? Like random folks who are like interested in them from the outside. How much does scale kind of play into what you guys are trying to do? Are you trying to scale this thing fast?
That's a great question. So traditionally, mutual credit networks have been local and constrained to a city or a region. And the benefits of keeping a mutual credit network local are creating a kind of closed value loop inside of a city or a region that really can strengthen the local economy and prevent the leakage of value to outside actors, such as Amazon, for example.
Right.
And there are two ways of looking at scaling. So on the one hand, merchants need a diverse enough group of trading partners in order for the network to really be valuable. And we found that is anywhere from 1 to 200 merchants in a given local region. So that's one side. We are also a financial protocol. So the resource protocol is built in a way that any community, region, any city can launch their own mutual credit network on the resource protocol and leverage their own group of underwriters. And so we see scaling in two ways, right? They're scaling the resource network, which is the first mutual credit network that we've built on top of the protocol as a pilot, as a demonstration, as a proof of concept, as a way to kind of prove to the world that this is a viable system. And then there's launching other networks, other local and regional mutual credit networks that are completely independent from the resource network. Eventually, we see ways to connect networks together. So let's say 2 years down the road, we may have 30, 40, 50 mutual credit networks. There might be some existing legacy or Web 2 mutual credit networks that come on to the resource protocol and use our software. And they may operate completely independently from the resource network. And they may have kind of bilateral agreements where there can be network to network exchange in a similar way that two countries have a bilateral trade balance.
Very cool. So I think like the question around scale for me is not necessarily I'm not trying to tease out your ambitions or even tell you what you should do. It's more about now that we're in this new context, how does that actually, is it the same, right? Because like scaling, when you have a relatively simple centralized system, it's pretty straightforward. Let me make more agreements. Let me scale. Let me make sure more people are using my thing being dollars or gold or whatever you want it to be, right? And I have a few levers. It can be, policy, it can be violence, whatever, right? There's a number of things that people can pull on there. So I'd say this is a super necessary thing, right? On the scaling side. I only say that because in the last 2 years, right? And Martin can quote us on all the right figures for this, but it's some absurd percentage of all existing dollars have been created within the last 2 years, right? Something like, 65%, some astronomically huge number. And so Americans are kind of the lagging indicator for this, right? We're seeing the pain in the last 6 months where people are like, inflation is really destroying this, that, and the other here at home in America. But folks who depend on dollars abroad for like island economies have been feeling that pain already, right? Almost as soon as it started happening. because they depend on international trade and the fossil fuel economy to get stuff to their island, right? And so my question around scale really goes back to that, right? It sounds more like you're scaling the system and its social relations and its adoption, and not necessarily the fiat system, the way that the fiat system is scaled, where it's agreements between governments, right? So I think when I say this is necessary infrastructure, I actually think of something like Collectivo, which I think you folks might be working with or not sure, but this might be a good time for us to kind of say, like, how do you see, in the real world of something like resource, how would you see scaling a resource within an island like Curacao, where they're experimenting with localized exchange trading systems on chain?
Great question. Yeah. So I like to refer to the Veer Bank, which is our kind of prime example of a functioning mutual credit network that's in Switzerland. It's constrained to Swiss borders. There are 62,000 plus small businesses trading in that network, and it falls under the jurisdiction of the Swiss legal system. So debt enforcement kind of puts a dampening effect on scaling one network across borders, because you need to have reliable debt collection enforcement for these systems to work. On top of that, the Veer Bank actually kicks out members once they hit 250 employees. So that kind of reinforces the values of the Veer Bank as a tool to support small and medium enterprise and prevent the centralization of economic power even within the Veer Bank. So that's kind of one example of a compromise between a national economy. Well, it scales, but to a certain point, and they've intentionally put limits on that. So we are really exploring another really interesting value add for mutual credit as an answer to the kind of incoming recession. And what I am looking at is kind of a deglobalization effect falling out from the Russia supply shock and the kind of sanctions and the increasing prices of fossil fuels and shipping. And when mutual credit networks are deployed locally within, let's say, an island economy, it creates, by necessity, people are sourcing from each other. And for maybe the first time in a while, local goods can compete with the cost of international goods because of the price increase in shipping, in fossil fuels, et cetera. So we think that island economies are really interesting test beds for blockchain-based mutual credit systems in 2022, given the kind of current macroeconomic landscape.
Interesting. And I think getting back to kind of the core economics of the platform, I think it's really interesting how you're using kind of two different currencies here. And as I understand it, you've got essentially transaction fees, which is one of the business models of the platform, right? So there's a transaction fee that's paid in source, right? And effectively that's undergirding the business model of the platform and the cash flow of the platform. And then you also have the RUSD, which is how we pay each other, which is essentially the currency of the mutual credit system. And what I found really kind of compelling about this is, so when I originally read the white paper, and even in our conversation, one of the things that came up for me was around how do you enforce that debts are paid on the system, right? So effectively, if we go back to our example again, I could take a bunch of, plumbing services from you and essentially pay for it with my credit. So I go through this onboarding process where you're looking at my historical bank balances, you're looking at my reputation score from Airbnb and Yelp or whatever else. You're pulling in a bunch of information to essentially allocate a set of credit to me in the system. And then after that, I effectively have to pay for services by providing services on the platform. But one of the things that I could do is I could essentially pay for a bunch of services and then not provide any services on the platform. But you've actually solved for that. And so the way that this has come up is kind of really interesting in the staking model. And I don't want it to be lost, because effectively what you're saying, and correct me if I'm wrong, is that when an underwriter comes on board and they say, David, we're going to give you 10,000 worth of credit, they're actually going to stake some of that currency against that, with the hope that their process of analyzing your riskiness was good enough that they're not going to lose the money that they've staked against you. Is that right?
Yeah, you've got it exactly. So underneath the resource dollar, there is a fractional collateral. So each resource dollar credit line requires the staking of an underwriter. And we are starting that fractional collateral at 20 to 30% of the value of the credit line. So it's not full collateral, but it's enough that the underwriter is extremely incentivized to make sure that they don't lose that stake, right? Because if they lose that stake, it's the equivalent of a bank losing their loan. And so they're very incentivized to make sure that the businesses, first of all, are credit worthy. And second of all, that there's a process in place that if the business defaults, then there's recourse on a number of levels. And one of the levels is the underwriter's stake is frozen. The underwriter can collaborate with a debt collection agency to recover some of the funds. And on top of that, there is a network reserve. So anything that's not recovered is covered by the balance of the network reserve. So the resource network also will take a small transaction fee from each transaction and put it into a default risk insurance pool. And some of these mechanics we have gotten from the kind of the Terra Luna pair, where Terra or UST is a algorithmic stablecoin that is in theory collateralized by the governance asset Luna, which is also the gas fee currency, right, for the Terra network. It's a little different because our credit lines are also backed by merchants themselves and legal contracts. But we found that pair very interesting. And that was an experiment that is proving itself out to some degree. We'll see how the Terra network scales and if that experiment will be resilient to the test of time. But that's only one of the kind of aspects of our model. Did I cover?
Yeah, no, it's great. And I think like just getting back to kind of the macro picture here, if you think about some of the biggest innovations in fintech that are not in kind of the refi space or the DeFi space over the past 10 years, you think about kind of these peer-to-peer lending platforms like Cabbage or On Deck, right? And often what would happen is these would essentially have high rates, high interest rates, and a small business owner would take out these loans that if you calculated the APR on them, they were just like in the high double digits and sometimes triple digits, right? And so you can never get out of this debt trap. Or you see this now with consumers, right? With the buy now, pay later, where you're at a checkout experience. 55% of consumers in the US have kind of had the experience of buying now and paying later. And 25% of those have said that they've done it because they've lost income, and about a third have made a late payment. And so you have venture capital kind of crowding into this space, this massively growing space where people are given more and more liquidity, more and more credit, but that credit of not having to pay today really has a negative impact on their ability to borrow in the future. It has a negative impact on their wealth. And so when we talk about the ownership economy, these fintech platforms have in many ways not enabled the ownership economy. We kind of think of credit as facilitating ownership over time, but in many ways, it's the exact opposite. And so what's really clever about what you're doing is you're essentially, the first layer here is essentially the staking, where you're saying, look, if you're going to provide credit in this system, you need to essentially, I don't want to use the word stake again, but you need to essentially back this particular member that you're bringing into the ecosystem because you've done diligence on them. And then if we go back to what Jahed was saying, right, about the local and scalability, what's really cool about this is you can have a local resource in kind of on an island nation, you can have kind of another local resource on the island nation, and then they can actually start being able to trade together because you've got the local partners that are doing the underwriting that are staking the local members. And then there's another element that is super interesting, right? So we had in this earlier episode, the current CEO of Gitcoin, Kevin Owocki, and one of the challenges that they had when creating distributed governance mechanisms is participation, right? So we all think that governance is good. In the case of Gitcoin, they just couldn't get people to vote, right? So you put something up to a vote in any of these DAOs and only 5 to 10% of people participate, depending on what sort of governance tooling they're using. And so what they moved to was a report card, right? Whereby participants in the DAO could delegate their governance tokens to those that were the most engaged. So if I don't have time to vote, there's a steward of the DAO, I can back them, and because I can see how engaged and how active they are in the DAO. And you have another mechanism for driving transparency for the underwriters, right? So effectively you've got the underwriters also have the ability, they're going to be competing against each other, right, in your system to offer credit. And then others can essentially can essentially invest into and invest alongside those underwriters over time, but based on looking at their past performance. So essentially the underwriter has a portfolio of members that they're offering credit to, and you can see the default rate from that particular underwriter, and then you can invest alongside that underwriter. Am I getting that right? Yeah.
Yeah, absolutely. So in our network, the underwriters you can think of like validators in a blockchain network, and everyone else who holds source tokens can delegate their stake towards those validators, which are essentially underwriters with track records. And sometimes these underwriters may be institutions, sometimes they may be individuals from the fintech or banking industry that have this experience, and sometimes they may be what we call community underwriters, or people that are underwriting from a more qualitative angle because they know their community, they know the businesses in their community, they know who's trustworthy, they're the boots on the ground.
Cool. Yeah, as you get into kind of the layers here on the white paper, it's just really fascinating the way that this kind of multi-stakeholder platform has been put together in order to take the offline kind of mutual credit system and solve for some of the key challenges that it had in an offline world, and in order to scale online. So sorry to put in one more thing, I think, in going back to that cabbage example, and if you look at fintech lending platforms and banks and what's available for SMBs in places like Africa and Latin America, often the interest rates do add up to over 100%. And what we're doing with resource and mutual credit is disintermediating that for-profit lending entity that needs to extract interest. And so that creates a scenario where credit can be made available to small businesses at very favorable, very competitive terms that can be, let's say, 1/10 of the interest rate available in some situations. Very cool. So you've made some kind of interesting decisions on which blockchains to go with. Can you talk a little bit about what blockchain this is all built on and why you decided to go that route?
Yeah, so we initially deployed our proof of concept of resource on Ethereum a couple years ago, and quickly ran into the scenario where the gas fees paid to the Ethereum network were more than the value of the goods and services being traded by merchants. Let's say a $5 coffee with $80 gas fees in Ethereum. And this is 2020, before we saw spikes in the Ethereum network. So we quickly realized that Ethereum as it is today is not really appropriate for our use case, the Ethereum mainnet. So at the time, there were only two other real options. There was the Matic network, now Polygon, and the Celo network, which had just launched. And we think that both are great projects, and we spoke with both. And ultimately, we landed on Celo for a number of reasons. So one of the reasons is that I had a conversation with one of the founders of Celo, and he actually referenced Charles Eisenstein, one of the economists I had studied years before. And that really impressed me because, having been in the blockchain space for about 8 years, I had never really found that interest in what is emerging now as refi or regenerative finance. And I was really happily surprised to find that there was a blockchain ecosystem that resonated with the values of regenerative finance, ecological economics. So that was one real kind of pleasant surprise. The other discoveries were that Celo was very focused on real world activity, on solving real world problems, which I had thought when I discovered Bitcoin back in 2014 was the promise of these kind of global remittances, low transaction fees, and kind of financial inclusion. And that is core to Celo's mission. They're focused on being a mobile first blockchain. So designing blockchain technology in a way that works for the 5-6 billion people around the world that don't have laptops, but access the internet through mobile phones. And therefore, the Celo network itself is populated with an ecosystem of fintech startups. I think of them more as fintech than blockchain. Fintech startups that leverage blockchain technology for real world use cases. So there's a ton of really interesting startups in the Celo ecosystem that we think we can integrate with down the road. For example, lots of remittance and freelancer and microcredit platforms in Africa. And these platforms that are all built on the Celo network and therefore the same kind of blockchain network as we are developing their own user bases, their own data about their users. And these will be perfect integration partners down the road for us to integrate with. So we see Resource as a kind of composable financial primitive for the DeFi ecosystem. And we think Celo is the place where it will be the easiest to kind of spread and integrate that kind of component. And yeah, I think that covers it. Also, the transaction fees on Celo are currently about 1,000th of a cent, I believe, which is even compared to Polygon, that's orders of magnitude cheaper. Oh, there's one more thing. Celo is great for connecting with the kind of regulated financial world because Celo is so focused on building fiat ramps around the world and therefore kind of plugins to the normal economy, especially in emerging markets. Since Resource is not like some DeFi protocols where there's no KYC and everything is anonymous, by nature with Resource, we must KYC all merchants. We are in the space kind of between DeFi and CeFi. And therefore, we think Celo is a great partner in terms of our go-to-market. That being said, Resource is a blockchain agnostic protocol, and we do foresee deploying other networks in the future in various blockchain ecosystems.
Very cool. And there's kind of one thing about the white paper that I thought was pretty cool, just in terms of the CIP36 versus ERC20, and why you had to essentially create this new token or this new kind of, I'm not sure the best way to put it, but effectively walk us through that, because it's kind of an interesting twist that, people that haven't thought about it, kind of negative balances, might be interested in.
Yeah, so we had to develop a new sort of token standard that we call the CIP36 or Celo Improvement Proposal 36. It's a modification of the ERC20 with one important distinction. So ERC20 token balances can only be 0 or higher. In order for a mutual credit network to function on chain, by necessity, you need negative balances. And this wasn't possible before in blockchain. So we actually developed the first token that enables a balance below 0 on chain. And I've asked a lot of people that have been kind of deep in the blockchain world for years if they've ever seen an on-chain balance below 0. And I haven't found anyone who has seen that yet. So we created this token standard, which is essentially very similar to the ERC20 with that one modification. So when a token is sent from a wallet with a balance of 0 or lower, what's actually happening on the contract level is new tokens are minted into circulation. And therefore, these merchants and small businesses have the power to mint credit in a way that wasn't before possible in blockchain. And one of the things that we think is really interesting with the CIP36 is that it enables merchants from the default world, from the normal world, to be onboarded into the crypto space and start spending crypto before they acquire it. So acquiring crypto, buying crypto on Coinbase with fiat, converting it to another crypto or getting it on the right blockchain, that's all really difficult for most people still. And we believe that DeFi and crypto won't scale until they solve these UX problems. So what we've done is create a way that merchants can spend crypto before they have it. And we've also abstracted the blockchain UX. So things like MetaMask or platform gas fees paid in the base token of the blockchain network. We've abstracted all that, as well as the private key, in a way that the user experience is somewhat similar to a Web2 platform like PayPal or Venmo.
Awesome.
Super cool. Well, David, there are a couple of things I kind of also, like Martin did a bit earlier, I wanted to turn back to before we'll wrap this up soon and have you on your way. Well, a lot of what you said just reminds me of reading Graeber's Debt like years ago, right? And like in two particular ways, right? So I think like one of the points that stuck with me from reading Debt was this point around how debt was probably the first system that people used in the sort of this history of money. Debt probably came first, one of the oldest means of trade, followed by cash and barter. And then the other bit of it being that cash and barter kind of came into play once we started having situations of low trust. And it's almost as if you're kind of going through this loop where we're like looping back towards kind of scaling IOUs and scaling debt as a form of interaction. And then, like you correctly sort of saw with Bitcoin years ago, there's a way now to kind of solve for the low trust, but not introduce the fiat currency system that's sort of backed by policy violence and a number of other things, right? So I think where I'm trying to go with this actually is that let's say, if we thought about seeding resource network in various island economies, and then let's fast forward 10 years, right? What sort of social reorganization would you kind of see if you zoomed out on Earth, right? Like one of these things I'm really thinking about is Herbert Simon used to say, if aliens came to Earth and they looked at us from above, they would see these big islands interconnected with each other. And people are like, what do you mean? Like countries? And he's like, no, it'd just be firms. Like one firm transacting with another firm across borders, right? This one and that one. And these are like the centers of economic activity. What do you think with the way that you folks are using, this really innovative way of thinking about debt and trust? What would our networks look like if you kind of if resource reorganize social relations?
Yeah, that's a fun question. So yeah, I'll go back to the CIP36 first, which is essentially the token standard for mutual credit tokens and mutual credit networks. And the first CIP36 that we created is the resource dollar, which is nominally pegged 1-to-1 to the US dollar. And some might say that the US dollar is not any longer a stable currency with which to peg. And the CIP36 by nature can be pegged to anything. The resource DAO could vote to change the peg. It's not backed by a US dollar 1-to-1 in a bank account, and therefore is very distinct from what we call stable coins or digital fiat, as I think from USDC, USDT, et cetera. So a CIP36 token of an island like Puerto Rico or Nassau could be pegged to a CPI, a basket of goods, some local asset like a coconut. Like I remember going to this island in the San Blas, Cunayala, off Panama, and they had a currency that was a coconut. That was their stable coin, if you will, because that was the main productive asset.
That's awesome. That's like another. We should write the white paper on natural capital assets, right? The coconut class. There it is.
Yeah, there you go. So I think that in a mutual credit system, what's interesting is what are the goods and services traded locally within that network? And can we create a peg that's meaningful to that local context and local economy, and therefore not only shielded from outside monetary policy and things that are happening with the US dollar today, but also stable against the inside economy, and therefore it's kind of a monetary policy tool. So we're really interested in working with people from the open source community to create these CPI mutual credit currencies that can have meaningful local pegs. And how we see this developing over years is kind of these open standards and experiments of how you can create stabilized trade currencies, mutual credit currencies, and having, let's say, two islands in the Pacific. One has its own mutual credit economy, so does the other, and they create a bilateral trade balance. And this is possible maybe because not only do they trust each other, but there's also underlying collateral on both sides that might be in source token by underwriters. It might be in another form of collateral, but that collateral creates the kind of ability for both sides to further trust each other because there's now collateral behind trade balances or trade deficits. So what we envision is a interconnected network or an interconnected system of mutual credit networks where each kind of individual island or mutual credit network has its own economy, but also has the freedom to develop bilateral trade agreements with other economies. And any mutual credit system with enough source, or in the future there may be other forms of collateral as well, will be part of the kind of high level protocol DAO, which is based in Switzerland. And kind of membership into that DAO on a network level, we envision various networks being members of this DAO and creating standards for which to govern trade between the networks.
Got it. I think that's a pretty cool summation, I think, because then that way, at least when you're pegging to local economies, you're increasing the interconnection of everything. Like if you were thinking of the Puerto Rico picture, right? If we zoomed out from the Herbert Simon pick, we'd have We'd have Chiquita Banana Dole, what is known as Dole now, right? Would be like, doling out fruit, and then there'd be a bank from Sabadell, maybe from Spain, and then the US, and they live enclave, and that's the three interconnections you get on the island, right? For roughly, right? And then but now maybe you replace it with a density of complex interactions from peer to peer and business to business on the island, but you're not reducing connections, right? There's still going to be connections outside, and that's really critical, I think, because it's not that we're saying return to monkey like they do on the internet, right? With like a primitivist take where it's like, actually globalization was entirely bad and we shouldn't do this anymore, right? It's actually saying no, complexity is good. There should be more of it, right? Like there's these artificial barriers to more complexification of social interactions in the economy, and let's make that easier. That's my take on it. So like that, I think it would be really cool to zoom out a few years from now and see that.
Absolutely. Yeah. And if you look at the kind of successful stories of industrialization in the 1960s, 70s, 80s, Japan, China, South Korea, a lot of them didn't follow what the kind of World Bank and IMF prescribe today, which is open your markets, free trade, capitalism, unbridled capitalism will save us all. Even the US doesn't do that, what we prescribe to other nation states. And so what Japan, China, South Korea did is they created this kind of insular system where certain industries were nurtured and protected over time: electronics, hardware manufacturing, car industry, semiconductors, et cetera. And now those countries are world leaders in those industries. But it wasn't because they opened up to kind of free international trade without tariffs or anything. It was because they carefully designed and protected certain industries in a way that they were able to nurture them over time to become globally competitive in the way they are now. So looking at mutual credit, we can see similar types of kind of financial engineering that enable island economies to nurture and grow certain industries by shielding them from kind of unbridled globalization while still being open to interacting with the global economy in ways that are on their terms rather than on the terms of the World Bank or IMF.
Yeah, so super interesting kind of connection to infant industry policy, kind of the role in development economics. I think so this is all super optimistic. Where I get a little bit scared is when I look at 25% decline in wheat due to a war, and one country on earth without democratic governance hoarding most commodities, right? Because effectively, if you wanted to use the system, there's a bunch of countries that are going to go into a famine over the course of the next year. And for the past 3 years, China has been hoarding food, right? And so you could imagine setting up a trade system that's trading kind of food in exchange for, I don't know, other assets, the right to, similar to what they've done with their Lend-Lease programs with their string of pearls around Sri Lanka all the way to Athens. So it just goes back to why governance is so important, right? Like it's not just about building these kind of composable Lego blocks and building cool blockchain tech and, building kind of these interesting new DeFi products. You have to have the governance on top of it, because the same tools can be used for undermining the progress that's been made by these emerging markets or by, these countries that are still trying to get up the development curve. So really powerful stuff. I really enjoyed reading the white paper. I read it like 14 times to understand this stuff, because I'm just not as smart as you, but I feel like I get it, and I'm super impressed and very hopeful that this thing, becomes huge, and all these little kind of local economies coalesce into a really powerful global mutual credit system. So thanks so much for joining us. If people want to follow you online, where can they follow you?
Yeah, so my Twitter is my name with a 1 in the middle, the numeral 1. So David1 Casey, Casey is my last name. That's probably the easiest place. And to kind of agree with the last thing you said, in blockchain, as in many other things, what we are potentially doing is just recreating the current financial system with all its inequalities on chain with this kind of hyper powerful financial technology. And if we don't think about how to create fair governance systems and systems that ensure different outcomes, then actually what we're doing is just recreating the current system and entrenching it for future generations. And so, that's why I believe that thinking about these types of governance systems is so important. And some of the work, I want to give a shout out to DXDAO that they're doing with reputation-based governance is fascinating and something that we're following closely, because if you have a system where one token is one vote and people can just buy tokens, then the system can be bought by corporate or government actors, and similar outcomes will play out to the current ones. So yeah, I think looking at things like reputation and how do we actually empower the users of a system will be essential to creating outcomes that we actually want.
Awesome. David, thanks so much for joining us. I'm really looking forward to following progress with the network and where you go with this.
Thanks so much. And it's been a pleasure.
My girl gave me a boat.